Good morning, everybody. How you guys doing? Hey, Jen. What's up, guys? Everyone had a good weekend? Yeah. I thought this week went pretty good. All the calls were spot on. All our overly bearish quant predictions from last week were spot on. Except I PDT'd. Well, yeah. It's it's really there just to screw you over, so don't feel too bad about it. We're falling faster than a Boeing emergency exit door this week. Yeah, actually, I'd expect Dow to probably take a hit tonight with the news about Boeing, and I think I just read that like another airline grounded even more planes. So I'd really hoped to dive deeper, but it was profitable for me anyway. Yeah, I mean my expectations were kind of still a little bit muted. This range still presents a lot of risk for the Vega exposure that's currently on the chain, and so some defense of it was to be expected. Um, and the data was kind of middling. We kind of ended up with a lot of data that fell on both sides of the fence, and so I think that prevented us from really sliding. But we are now even more substantially below gamma neutral. We're closer to delta neutral. So there's a high likelihood of either a strong bounce or a continuation. Google down 5%, Apple down around 10, Amazon down 7.5, Tesla down 11.5, Meta down 6 and bounced, Microsoft 4.6, Nvidia and Netflix are hanging on. Do you expect these to continue correcting? They could. Yeah. I mean, we've seen a higher degree of volatility in the Mag 7 in the past, and the trade is unquestionably overcrowded. From and I would say the biggest thing here is that we're seeing it pretty rapidly. And there's a lot of correlation to back in July, in how this is breaking down with the increase in yields, Dixie starting to climb back up. We're starting to see a little spark in volatility, but not much. It's still very constrained. But Apple lost 12% from July, end of July to August 18th. So from the end of the month until OPEX. At which point it climbed up. And then went right back down again. But you know that whole period was extremely volatile for the Mag 7. We're down about 10% now, 9.41% on Apple. So I mean, if we use this as like the baseline, given it's still the largest of the Mag 7, um, right? Yeah, still the largest of the Mag 7. I would say that there's a little bit more that it could go, but I do expect a continuation of the downside to be defended to some degree, mostly because short vol hasn't given up any of their positioning really. But we were seeing 8% swings back through August, September, October, both to the up and downside. So I don't think the amount they're down really tells us anything about how far they could drop. I will say that, there probably isn't a lot of fear on this pullback. It was largely expected by most of the market. We'd simply run too hard, too fast. So, but if it keeps dropping, that fear will show up, right? Everyone's been buying the dip probably for a few days now. Um, and if it keeps dipping, that's going to spook a lot of people. So we really have to see how that ends up. Morning trash. All right, later, Thunder. Your volume sounds low and I'm maxed. I have it turned up all the way, Bob. All the way up. I literally can't get it any louder with my setup. Start hollering, just scream. You're fine on my end. Okay. Well, that's good. Why don't you get better fucking headphones, Bob? Have you tried that? Morning, Pickle Man. I hope your weekend went well. It's been okay. Hectic. It was a pretty hectic weekend. I had to get a lot of shit done, but I got everything done for the most part. Uh Heads up, tomorrow morning I'm gonna be a bit late. Probably get to the stream around noonish. I've tried headphones and just speakers. You can get there's like a plug-in for Chrome that allows you to turn the volume up even higher. I think I'm better at trading today than I was Friday. Well, that's good. It's quick improvement. I currently look at the chain for BX, June 2025. OI is somewhat liquid, down to $65. Yes, we could discuss BlackRock. I'm already short BlackRock. I mentioned that about a week ago in the Discord, a couple other occasions, but there doesn't seem to be any problem with liquidity there. I think everyone kind of expects the worst from their CMBS. Blackstone. I think it was like a couple days ago they handed over the keys to something else as well. I know a lot of that's gonna be popping up in the first half of 2024. Um, like 12% of the total CMBS are gonna be refinancing, right? Blackstone, BlackRock, they're all the same shit, right? Vanguard. AIG. Is Neo considered a long-term value buy and hold type play, or do you consider more of a short-term price improvement type play? I think it's more of a long-term, well, not necessarily a long-term value play, but maybe over the next 6 to 12 months is kind of the window I'm looking at. It's highly speculative, as would any Chinese stock be currently, but if their economy is able to get back on track, I think delivery numbers in China are pretty impressive. I think there's a route to the American market for both Lucid, Neo, and not so much BYD, but and were they to explore that route to the American market, I think their numbers could increase even more substantially. I think they're pretty cheap. Um, and I think the effects of the Saudi investment fund buying 20% of their float have yet to be felt by the market. So I think a re-evaluation. It's a very liquid stock. It's not a particularly good like short-term play or volatility play, but I think we can see some price improvement on it over the year. Baba's another one with some potential, but possibly a little more risk than I would want to take. Simply because of the price. So that one I'm still kind of thinking about. Some other things that might be interesting into the second half of 2024 would be like long yuan. Could be worthwhile. Um, there was another Chinese company I was looking at. I forgot the name of it. Uh, Baidu. Baidu looked kind of interesting too. I expect emerging markets to do pretty well this year, but I want to focus on Japan, China, and Mexico. Why Blackstone instead of BXMT? Is that the mortgage trust? Isn't that their like REIT? There's not really as much value to get out of this, frankly. I mean, this is just performing like shit anyway. At least Blackstone's worth shorting more. I mean, could this just go under? Maybe. Yeah, that's a possibility. That might be worthwhile, but it may not. I hope you had a good week. Offhand, do you know the typical multiplier for crude oil shipping tanker companies? That caught my eye. Looking for sub $4 a share entry to start. Um, Not off the top of my head. No, I think I have some research written down, but I was mostly looking at dry shipping and not so much at tankers. So I'm sure I'd have to adjust some things to get an accurate number there. BXMT is the REIT specifically, yeah. But if BXMT goes under, my firm will also go under, and I will be a full-time trader. Well, yeah, that's a start. What's up, Dork? Good morning, man. All right, so I think we'll start with like the memes, and then we'll go over like Mag 7, how they look, and then we'll hop onto the quant chat. What's up, Carl? So GME is continuing to see very little shorting. Still not very aggressive. We haven't seen the dispersion trade breakdown in markets, and we're still not seeing an excessive amount of shorting on like XRT or the rest of those like predominantly volatility shorts. So still pretty lax, but getting very close to falling below delta neutral. I believe delta neutral here is in the $15 range. $15.86. So just about there. About 10 cents off. Once it falls below delta neutral, we can start to see it, fall off more substantially. as we have in periods in the past when it's fallen below delta neutral. That'll be a more advantageous time for puts to come in because volatility will be largely crushed at that point. If you are shorting GME, and not just selling vol on it via covered calls, um, generally the breakdown of delta neutral is the ideal time to enter, like put like longer term put positions, like 30 to 45 DTE at the money. They tend to perform far better after a breakdown of delta neutral than they do when it's still above gamma neutral. And volatility is still kind of all over the place. So at that point, you shouldn't be overpaying for vol anymore on the put side. It tends to be a little bit more advantageous. Upstart broke through DN at the end of last week. Really nothing supporting price here, all the way down to like $17 on the option side. I would say maybe we could find some support at the $30 level, purely off of like the psychological level there. But I think as long as the rate increases and credit environment remain in question, we're probably more likely to see downside here than a rush of bulls. And I don't think we have any data that's really going to shift that expectation besides maybe CPI. So if you are short this, you may want to get out for CPI, see how it turns out, and then maybe get back in, or at least hedge the outcome of the print. But we don't have the Fed meeting until the end of the month, so really not going to have a lot of information that's going to sway the current projection, which just trimmed back a little bit last week with the stronger labor data. Still pricing in, I think, a 70% rate cut for March on Fed fund futures. So um, there are still strong expectations of cuts in the first half of 2024. I still don't think we see them, but that's more opinion than anything else. Fubo kind of flat. It's been moderating a bit, right at like the $3 level. It finally did break a little bit below this week, but it's managed to hold that long-term trend on the downside. I think over this week we have the ETF. This is like the back end of the ETF FTD period, and with the holidays, it should be where we start to see settlement. Um, and so any shorts in IWM, IJJ, IJH, we might start to see some of those getting covered. And liquidity kind of flow back the other way on Fubo. If that happens, I would say that we could probably, depending on the veracity of covering, I would say that 350 is possible on a break. Maybe let's say above 325. Well, let's say 320. So a break above like 320, I would say 350 is possible, and that could extend as far out as like 390 to $4. So that looks kind of primed for something to happen. There's still a decent amount of liquidity there to short, and if indexes are going to continue down, that could kind of weigh on any ETF FTD covering, and it could trade flat. I don't think it'll go down much, but there could be an expectation of flat if markets continue to decline, right? Mostly because those active funds are going to continue to provide liquidity, and we won't see as much price action out of the covering. I still have like 25,000 shares of Maersk, but I sold 3/4 of my holdings so far. I was up more in a month than I expected to be in 2 years, so it seemed like a good idea to start trimming. ZOM or Oxy for long-term buy and holds and to sell CCs. I mean, ZOM is strictly better for selling covered calls, but especially if you're pretty in tune with the dynamics, because you can get away with selling them in the money quite a bit. But I think long-term potential, I like Oxy more. I own both. Um, I actually ended up not getting assigned on my in the money ZOM calls over the last couple of weeks. Um, but I find it a little harder to get decent liquidity on Oxy for covered calls. At least when I want to sell them in the money, and that that ruins some of the yield. Uh, but I think as they broaden their infrastructure in the Permian Basin, they have a pretty distinct advantage over a lot of the other companies looking to extract from the same sources. So I do like Oxy. I don't like buying Oxy for more than Buffett buys it for, which is around like $56. So it's not something that I would recommend looking at unless you see a pretty big drop in price. Or at least I don't like it at those prices. Sirius, I know Buffett bought some more, still a $5.50 stable coin. Maybe with the newest Burke buy, we'll see a slight improvement, but somehow I doubt it. Shorts here are still pretty rampant, as you know. They're long the Liberty Media Group holding short Siri. It's a huge arbitrage trade. Um, it's probably not going to collapse unless something forces it to. And I don't think Berkshire buying a few more shares is really going to be the nail in that coffin. And the people involved in that trade are like big banks and investment funds with huge amounts of capital. They don't really seem to have a problem keeping a lid on the price. At least they haven't yet. Besides that one brief spike up to like $8. It could break out again. One value about Siri that's kind of nice is while collecting the 2% dividend, you can lend out shares at 30% APY. So quite a lot of yield to be had on something so cheap. And then you could probably even compound that with covered calls, despite the volatility not being very high. I'm sure there's some yield that could be garnered off of that as well. So that may be something interesting for anybody looking to pick up like a small like theta position or something there. I think puts tend to be a little skewed a little favorably here. So CSPs might be interesting. I think last time I looked, the 30-day CSP was like I guess it's like 26 now. Highly illiquid. I guess you'd have to go all the way out to Feb. And the Feb 16, the $5 CSP is around 29 cents. So roughly a 5 point, what is that, 5.8, 5.7% yield on 40 days plus quarterly dividend plus share lending, right? So a lot of just churn there for alpha. Any update on tech? No, I picked up some at 1350. It was performing well while the yen was going down, but I've picked up very little. I bought like 800 shares. I don't want to. I don't really want to get more. I want to wait for like earnings misses. I think they're gonna miss on several earnings over the next like year. Um, and so I want to use those opportunities to buy it where at a price where I think it's really deeply undervalued. Um, and as the yen carry trade breaks down, as their pipeline starts to fill up, I think value could be seen in a couple years from that. So probably not going to get a lot of updates on it, but I did pick up some at like 13. I think it was around 13.50 recently. I had a buy set up, but yeah, I'm still waiting to see prices much lower on that. And I kind of expect them to be realized. Top, they've been shorting the shit out of it for the last week. Um, Liquidity's been getting tighter and tighter, but the price isn't really going down anymore. I think it's pretty safe to say that it's found, some support on this trend. And we may not return to that like $1.80 range that I was really hoping for. This also largely affected by ETF FTDs possibly coming in this week. And maybe we see a bit of covering. Um, in the small period of covering that we recently saw, we didn't see a lot of liquidity actually stopped let go, but we managed to run to 260. So I think the illiquidity definitely benefits price improvement in the event of volumetric covering. Um, it looks like it's something I have a little bit of exposure to. I don't mind probably getting a little bit more exposure this week. Um, but I do think that there's an incentive to keep the price suppressed until the announcement on the 19th. It's going to give some guidance on their restructuring. So, um, it may be good to have like exposure for a couple days, and then if it's not really going anywhere, cut it and wait and build more exposure out towards the 19th, or use the period of lower volatility right now while it's being actively shorted in order to pick up longer dated positions at like 2 and 250. And that way you have enough theta to carry you through the announcements. And I think the earnings report isn't coming out till Feb, so might be some opportunity for going long here. Might be some short term opportunity here. That's kind of harder to tell, but volatility's moderately low for where it usually is. Obviously, volatility on it's ridiculous, 200% or something stupid. But it is a little bit lower right now than when it's running. Beyond pulled off reg show this week, and it's been a little while since I've done this shit, but if I remember correctly in the past, and I think I have some of the reg show periods and Upstart still marked, being removed from reg show uh, had kind of mixed results. Um, it either led to some immediate price realization ahead of getting pulled, which is expected, right? Because they're trying to cover as much as possible. Um, but over a few day period of shorting, eventually led to like a bigger amount of covering. I remember specifically this one right before it went right back on reg show after earnings. We saw Upstart move from like was it $13 back up to like 23. Um, this period when it came off reg show, it ran really hard the next day, then got shorted down. This period it went on reg show, ran when it came off, it got shorted and then ran really hard again after earnings. I don't think Beyond has an earnings call anytime soon. The next one's Feb 24th or Feb 22nd. Feb 22nd. But the situation's a little bit different. This has been on reg show far longer than we ever saw Upstart on reg show. I think it's been on for like 40 plus consecutive days at this point. And they've also been pushing a lot of the forced covering off onto the ETFs. So the underlying has been getting more liquid while the ETFs are becoming less liquid. And this has been happening over the course of a few days. So they're using ETF liquidity to satisfy the reg show requirements. And depending on how much they've leaned on that synthetic liquidity, they could have a substantial amount of obligations built up. And the realization of those obligations getting covered is what, largely drives price action on these stocks. So how to approach this? I still think averaging in with theta is best. That way you can cover multiple reg show periods. It's tough on this one because you don't want a lot of exposure to the underlying. Like Upstart was a really good company. GME even had, future financial improvements to look forward to. I don't think that's true with Beyond. I think Beyond is in a similar situation to what those stocks were, but the shorts are right here. I don't think they're. I don't think they're wrong at all. I think the company is a mess. It's probably going to go bankrupt at some point. But they've just simply gotten way too greedy, right? Far too many shorts have showed up to the table for a piece of the pie, and there wasn't enough for all of them, so they've made a bunch of synthetic pies, and they've eaten those, and now they're fucked. So yeah, I mean, upside exposure is good, but be warned that it could get shorted down. Let's see what range. Probably about $7 right now, but it could potentially go a little lower. So I would say between 7 and like 550 would be the range I would be looking for shorting. But I do want to note that this is the ETF FTD week, and if there are ETF FTDs on this that need to be covered, we may see that turn around. And Friday, we saw dealer Gamma and dealer Delta both pick up, actually Thursday and Friday on it. And while Charm is still negative here, we are seeing an increase in sold puts. And that's something we tend to see in advance of covering. So keep an eye on it. I don't know, maybe some short dated exposure through the ETF FTD period, and then longer dated exposure as it gets shorted down would be a good idea. As you can see, there's still a little bit of liquidity left there. Not a lot, but a little. Then moving on to the memes, yeah, Apple retesting the top side of its long-term trend. This is kind of an important psychological level for Apple at 180. This is pretty far below, like the June high now. We're below both the peak of August and end of December. And people who are buying the top of Apple over the last 2 months at this point are now underwater. That may lead to a continued sell-off. I would say if we see this breakdown much further, it's likely to slide a lot further. Usually there's kind of like a gearing effect on Apple options chain, right? So it tends to pick up and lose momentum very, very slowly. And right now, it doesn't have a lot of momentum left. I think Friday, we saw a decent amount of call positioning come in, but if that fails to stabilize the price action, and it continues to slip, it's going to be pretty bearish. I would say a move down to below 178 could see a move towards 150. So quite a lot of range there. Next up, we've got Amazon. Obviously, this week hasn't been great for Amazon, but it did find support in a range where it's been fairly stable over the last couple of months. I think there was roughly 3 billion and 3.5 billion in positive dealer adjusted delta, and gamma was up, was also positive. So a little bit of short dated call interest coming in there. Definitely some dip buying going on, I think, across most of the Mag 7, as I think people expect this drop to start to turn around. However, if all these dip buyers get blown up, things are going to fall a lot harder, right? So that one looks pretty stable here. I don't think a loss of 45 matters so much, but if it were to start to fall below 140, I would say it could start to pick up even more downside momentum. And I think we're gonna find that to be true with a lot of these. AMD actually looks kind of bullish at the end of last week, if I remember correctly. I know this isn't part of the Mag 7. Yeah, AMD dealer delta picked up a bunch last Friday. It slipped negative charm for like a day here, and then it bounced right back. So charm moving up into the end of the week. Call interest picking up, and short put interest picking up. The last time this had the same test was back here. I can kind of draw the point at which it bounced through both of these. And obviously that call buying led to a significant breakout over the next like 4 days. And the setup looks extremely similar, maybe a little lighter on the call buying, so it may not have as much range as it did on that move, from 17 to like 140. But it may be able to move, 150, 160. I don't know if another day of compounding is needed to go long on that, but you would want to make sure that if it fell back below 137.04, that you limited exposure to the upside, because if it fails this bounce and falls back below that resistance, very bearish, right? So yeah, if it fails, and I think this is at like 137 right there. So if it fails this and drops, it can drop, I don't know, 125 and then 115. So it's got quite a lot of range to the downside that it could fail. But if it continues up, I think it's got and that call volume continues to come in and support price, I think it could have a range up to about, I don't know, I want to say like 150, because there's gonna be a lot of resistance there and long-term sellers that didn't get out on the first test. So maybe like a move up to 150 and then reject, and then maybe another move higher later on. I haven't gotten to Netflix yet. I will. I want to do Google. Let's see. Google. Which one do I have here? I just have Google, right? Okay. I just want to make sure I'm looking. They have different options chains, so I'll make sure I'm looking at the right one. This one still just doesn't look bearish at all. I know it's been coming down over the last week, but uh, dealer delta and gamma have fallen off, but they remain positive. The call interest, like the longer dated, especially the longer dated call interest in this range, is still quite strong. It hasn't sold off much. Um, I think charm is still positive. We don't see anybody really leaning very hard into like Vega positions, and that might be like the lack of put selling might be an indication of bearishness, but I would say that this could probably pretty easily find support at 135. That's a couple dollars below the current price, I know, but yeah, that's just kind of the effect of momentum. Um, so maybe still continue down to about here. At which point, it's either going to find support at that level, or we're gonna see that call interest start to break down. Now, if that call interest starts to break down at that level, and the dealer starts selling the flat tape here as part of their hedge, uh, that could move more extremely to the downside. I think Delta Neutral particularly is very, very far out of the money on this at like 120. So that would represent about a $15 drop. And I could see a test of DN before finding the next real level of support. Generally, Google doesn't have a ton of options interest, so Gamma's not as effective as Delta. Um, and most of the calls on the chain are longer dated, so I would expect that to be a far harder resistance than Gamma Neutral. Meta, eh, I don't think anything's broken down. I don't think anything on Meta has changed at all. I've been watching it, but it's just fucking trading flat. Yeah, it looks like almost every Friday call interest picks back up on it again, and it kind of just stays where it is. Um, this might just see move back to like 162, maybe even higher over the next few days. Maybe a new all-time high. Yeah, gamma call interest, gamma, delta, all picked up into the end of last week. So the dip buying here with basically nothing pushing against it, I think I'll just drive it higher. I don't think this one's got that same charm risk that we see on Google or Amazon or Apple. I think it's well above any point at which it would go negative on charm. So this one just up, right? And who the fuck knows where? It's already at all-time highs, but I would say 362 at some point this week probably isn't, or over the next 2 weeks isn't ridiculous. And then from there, it could just move higher based on the chain, 65, 70. Microsoft. Now, Microsoft has been not doing so well. Maybe underperforming the most out of the Mag 7, at least on the options side. Buying of call options has been really erratic. We've seen calls flood in and then fail, and then flood in and fail, and flood in and fail, and in huge quantities. The gamma on it and delta on it as of Friday are positive, but I'm not really sure that's going to lead to a ton of price improvement. The top end is about $10 higher than where we're at right now, and then the bottom end is well, we're kind of at it. So I would say that with the big push in call interest, it's probably really likely to see this like 372 to 376 range. but that interest can break down really quickly, and we've seen it happen a couple times. And almost all of these like big downside tests are then immediately met with more call buying. But overall, the effect of that is that it's trading in a very tight range, right? I wouldn't say it's got a huge risk of coming down really hard right now. But be warned that once it does run into those sold calls at 375 and 380, the chances of a sharp reversal are going to increase pretty dramatically. Netflix, small bounce and on the trend last week. The call buying here was pretty ferocious, honestly. And we saw a lot of put capitulation coming off of this big fail earlier in the week. I think it's going to continue down, but it may still have a little bit of time trading kind of in this upward range before we see it drop. Obviously, I don't want to wait that out, but that could be an inevitability of how things are positioned right now. I don't think Friday was particularly bullish for it. It had climbed earlier in the morning and then it fell off, and I think we see dealer delta and gamma fall. I think Charm's just barely positive going into next week, and like the call interests, like bot call interest has fallen a bit as well. On the neutral side, I'd still want to see it fall under 468.82 to confirm continued downside. But once under 468, quite a lot of range down to delta neutral, which is at about 416. So if this can pick up some downside momentum, which, especially off of the back of Friday's interest falling off, there's just a ton of range, right? I mean, all the way back, like to here is where DN is. So it could fall, and it could fall really, really fast if the market maker starts selling into falling prices. So this is something I think that would be it would benefit greatly from a failure in indexes this week. So if the dip buyers get blown up, and Boeing may be something that propagates that, but if the dip buyers get blown up and they capitulate and we see a move down on indexes to like SPX down to delta neutral, I think this may have the best range out of the bigger mega cap tech as far as downside is concerned. It's almost $50 of range, so it's quite a lot. Options are priced appropriately though, so Nvidia has just been chopping between like 500 sold calls and 480 sold calls for so fucking long now. I don't think it's really going to go anywhere until they get some negative earnings, or revise guidance or miss substantially. But right now it's in an uptrend. There could be $14 of range to the upside on that. The dip buyers here, interestingly, not very strong. And we didn't really see them come in at the end of the week. I think mostly just profit taking, and largely because this was up into the end of the week, whereas a lot of the rest of the Mag 7 were down. So we see dip buying there, and we see top selling here. This may actually move inverse to the rest of the Mag 7 through the middle of this week. If the dip buyers are right, and we see the rest of the Mag 7 move up, this may not benefit as much from that move. And we may see this, kind of reject off of those 490, 500 sold calls and fall, while the rest of the Mag 7 moves higher. Now, if they all fall, then this probably will too. But something to keep in mind, if you're looking for a short this week, but the market's looking bullish, this may be there may be a little bit of opportunity here. And I think that's it for the Mag 7. Oh, Tesla. Yeah, I mean Tesla I still don't want to short because it's still too expensive. I picked up a couple debit spreads on it this last Thursday. Last Thursday or last Friday? I think it was last Thursday. The zero DTE bulls didn't really have a substantial impact on Friday. It's gamma neutral has moved up a bit. But I would still want to see it fall below 236 before it started to get any additional momentum. Gamma's still positive, so its ability to bounce really hard presents a great deal of risk. I would say that if you want to short Tesla, it's still a little too soon. And Tesla loves to bounce off of gamma neutral, which it's coming very close to a test of. Gamma neutral right now at 230.38. If it falls below gamma neutral, I'd short it a lot more heavily. But right now, I maybe be prepared for a bounce. Looks like I could get one. Or at least protect short positions from one. And I think that's it. That's it on the memes and the Mag 7. And then we can turn it over to the quants. What's up, guys? Let me get the audio going here. 1 second.
Do you just make sure to pre-censor us so that way we don't accidentally tell chat that Jay Fresh and I are getting married in 2 months? I mean, what?
What? Oh, I might have awkward.
Wait, sound effects?
You're not allowed to use them, Jay Fresh.
Yeah, you just opened Pandora's box. I thought
He doesn't even know how to use them.
No, I do.
Oh, fuck, who told him?
Shit, we got to get the admins
Jesus
on this
Christ.
now.
This is gonna be bad.
Fortunately,
we don't know how to add any, and we don't have the ones from the old Discord, so.
Oh God.
Yeah.
You can just upload some. Yeah, I'll have to go digging for some really obnoxious and risky ones.
To help your mission, you can probably find like a soundboard on the internet that has like all the MP3 files ready to go, so that way you don't have to clip them or anything.
I want to get one of those old like Arnold Schwarzenegger ones.
Oh, those are the best, dude.
Yeah. Cookie? Who told you could touch my cookie? Get to the chopper.
Jesus Christ. Okay.
I remember back when I was like a kid, like watching the videos of the prank calls using the Schwarzenegger soundboard.
Oh yeah.
Back before people really knew what was going on.
What was that? What was that? What was it called? Like crank yankers?
Yeah.
Or something like that.
Bad.
Yeah.
That
no. Before there was a show, there was they made like tapes, and I remember finding one as a child, and it was some of the most disturbing content that a child in the early 90s could have ever listened to. We were so insulated back then, you know.
It's like a child who loves Full House stumbling upon Bob Saget's Aristocrats joke.
Oh God, yeah. Or just, stumbling upon Bob Saget.
Yeah. The Aristocrats is...
So I covered all the Mag 7. It looks like everybody's buying the fuck out of the dip on them. I hope they all get blown up, but that might not happen. Is there anything that we need to touch on from the macro point of view this week?
I mean, CPI.
Yeah, but it's gonna be soft, right? So that's gonna be bullish.
Might be soft,
Yeah,
might be flat.
I think flat-ish.
We still don't have healthcare back, and oil's not really up.
Yeah.
Do you have any duration auctions this week? We have a 3-year,
What we do? There's
3 and a 10.
There's 15
Ooh,
and 30.
there a 30 at
30,
Friday? Yeah.
30 on Thursday.
Is it Thursday?
Yeah,
How much 30s though?
flirty at 30. I don't know. That's a good question. I'll take a
The
look. Give
dirty
me a second.
30.
Touch fucking Treasury Direct.
Yeah. Let's just get the Treasury Direct. I mean macro too. I mean, it's the Fed, multiple Fed
Whoa,
members are
that's a
starting
lot of the 3-year. 52 billion
3
on the 3-year. 10-year, 37 billion, so kind of middling. The 42-day auction is going to be 70 billion.
God.
Yeah.
And then
then
21 billion on the 30-year.
Yeah, so
Dude,
52
those are
billion on the
quite
3 years
credit cards.
okay. 37 billion on the 10 years, not bad. 21 billion on the 30, I think is pretty meh. They're gonna
The 30 has the
waffle, but that'll
greatest
be fun.
impact though, so I mean, even if it prints a tail at 21 billion, it'll probably have some like immediate volatility impact, but I think it'll just get soaked up.
So what was the total issuance there? Like 100 billion?
Yeah, about it's a
So
little
we should
more.
check RRPs. We should
It's
check
like 100
RRPs.
and 170 billion.
Okay. Yeah, we should check RRP and see how much of the RRP is drained from this bout of auctions.
No, we can check overnight repo right now is at 694 billion. The spike from the end of the year squished back right back out of it. Looks like it found a floor at 667 last week and rose into the end of the week. Back towards 70. But 300 billion gone since the beginning of the year.
Whew.
Which is
Spicy.
fucking crazy. All of it going into shorting volatility, and trying to keep that from spiking.
Well, it's not just. I mean, it's shorting volatility, but not just in the equity market. I mean, it's going in.
Yeah, well, I mean, this is only going to last so long, right? And at the current rate of decline, we're looking at being like RRP being empty by like March. Which
Yeah.
at which point, if quantitative tightening continues, we're going to start to see the Fed's like the reserves held at the Fed deplete, especially if Yellen keeps issuing short duration.
Yeah, so I'm looking at the recommended schedule for bond issuance, and this week they're issuing about $20 billion of new money, so like 92 is rolling off roughly, and then they're selling, 111 or 112
All right.
billion. So it's actually kind of a light week relatively. The week after that, you've got 20-year bond, 10-year tips, 2-year note, 2-year FRN, 5-year note, 7-year note.
Okay. What's the roll
That's
off?
180, but they're issuing over $41 billion of new money. So that's going to be a big week.
Interesting.
And end of February, they're issuing like $100 billion of new money.
Jesus.
Which seems insane, and it's all in 2 to 7-year notes.
Oh, really? That's kind of a lot of duration.
I think probably this is going to get modified soon, right? Don't they have to like issue new schedules for at like
Not
the end of this month?
not until the end of this quarter, I think, right?
Well, I think they can issue. They're going to issue a revised one for the rest of this year. So this could change still, and then they'll provide guidance on the following quarter.
Yeah, I know halfway through at some point they issue a revision. And then yeah, the next guidance will be before the start of next quarter.
It's interesting to me how these issuances, like they seem to reflect the yield curve almost exactly between volumes of issuance and the yield curve. Like,
Yeah, I mean, I don't think that that's on accident, right? I mean,
oh fuck no, yeah. But like, it's
um,
just no one wants to uninvert the yield curve. It's ridiculous. I think J-Pow does, but Yellen does not.
well, yeah, I mean, they have competing issues, right? I mean, J-Pow wants to crush credit, and Yellen wants to keep rates low.
Well,
So
it's because she's the one
they
buying
have
the credit.
opposing they have opposing issues, right?
Yeah.
Which is really strange because that one Fed, I forget which one, but the one Fed this weekend talking about potentially reducing QT as the RRP runs out, and then talking about potentially raising rates further to offset that was really bizarre to me because I think we're kind of at the cusp of the point where further raises in interest rate is going to start becoming noticeably inflationary. uh, because something like a fourth right now or so of the deficit spending is on interest. And our deficit's already running at like just under 7% growth a year, whereas before the monetary or the fiscal impulse, it was closer to 5. So we're running 2% hot already, right? And if you increase rates, that number's going to go up even more. And I think right now I wrote about this a couple, either a week or two ago, I can't remember. Because we're spending, our deficit is growing 2% faster. I expect everything else, wages, inflation, et cetera, to also be roughly 2% higher. The spread should be about the same. So wages, I think, are going to settle in around 5, CPI 3 to 4, and GDP nominal GDP 6 to 7%. Now, obviously, as interest rates starts to become a bigger slice of the pie for the economy as well, which has slowly started happening, but not really. That will start weighing on in GDP, and then if in GDP starts slipping relative to the debt, then that's when it's like, okay, recession's coming. But I mean, so far it looks like the GDP for this quarter is going to be just fine. But anyway, yeah, I mean, I know that was all a lot, but I don't understand why any Fed governor would say reduce QT and increase rates. It seems to be the opposite of what they want.
Well,
Wait,
it's
who
because
who who said they wanted to reduce QT and increase rates?
Let me look it up.
that wasn't Barkin, was it? Barkin was on Friday.
No, Barkin didn't say anything new, and he wouldn't say something like that. It's gotta be someone else.
It doesn't sound like Kashkari.
No, it was a female. I don't know all their names, and I only know. I think it was a female. I don't remember. Someone said it.
Wonder who it was.
Hester?
mean, unless you find it, I'm not gonna remember.
All right.
Yeah, I
Anyway,
don't know what it was. But
ooh, gross. I was scrolling Twitter to see if I could find the news article, and I just got scrolled past a picture of that dude that was swimming at the Bass Pro Shop naked. Just,
it was Carl.
actually was Carl.
Poor Carl.
Yeah.
Well, do we want to? So we've gone over macro. I could zoom in a little bit to the credit market.
We can talk about some of the CFTC positioning for the weekend. We'll do that one. Just go into the credit market. Actually, Smooth Operator has a question, which I feel like you can answer. I don't want to get into it, but why are TLT and EMB trading in lockstep? And that's emerging market bond ETF.
I figured. Well, that's just because the global bond market is seeing money flow around. I mean, those are both bond. They're both correlated with bonds, right?
Well, they're both
And
high
the global.
yields, also.
No, TLT is the 20-year Treasury ETF.
I know.
But I see what you're saying. But it just has to do with money flowing in and out of various durations. Emerging markets have seen a decent amount of liquidity lately as people are searching around for some sort of safe yield, and emerging market, like people are getting kind of bullish on emerging markets.
I
But
am.
yeah, so yeah, exactly. But you'll see increased liquidity in both of them as there's a lot of repositioning.
Yeah, I
Oh, Carl
also.
caught a fin. He was in there. Nice.
So the Fed that said it was
Oh,
Logan.
it was Logan. Yeah.
So that's sort of why I would see those moving in lockstep, right? Like just global risk on, risk off behavior. Big institutions like JP Morgan, the one that runs this ETF, even they're always repositioning their shit. Like all those guys trying to stay ahead of any sort of economic trends, especially with the bond market, because that's where most of your capital is.
Yeah, I feel like as far as duration bonds go internationally, everything in the bond market's pretty much been in lockstep for the last year. I mean,
If they
you could go
weren't, it'd be really
outside of
bad.
emerging markets, look at EU, look at gilts, look at JGBs. I think you're gonna see those similarities pop up a lot of places. There might be more volatility in the front end of the curve in some of those places, but the back end's been interest there has been largely in line with tightening and loosening in financial conditions.
Yeah. So, good segue into the next thing. Do you see these charts in the general chat, Girk?
I don't, but I'm about to.
You should check them out. Let's start at the top and go to the bottom.
All right.
So, I mean, we could show the first chart. It's from September or August through, or it's like July through beginning of October of 2022.
Nope. What did I just do?
No, it was there. I saw it. Now it's gone. It went away. Girk, what are you doing to me?
I'm sorry.
I was on a roll.
I know. Just slow it. Slow that roll.
All right. I'll hold on for a second because I found this interesting. It's a little hand wavy. Just to kind of point out some behavioral things at first, and then
There it
we'll
goes.
kind of move on.
I got it back.
Okay, cool. So yeah, this is it's like end of June through beginning of October. Spreads between AAA, triple B, and then high yield AAA.
Okay.
So you notice that the spread on high yield jumped significantly, and then kind of tailed off for a bit, but that jump wasn't followed with the between AAA and triple B, so that spread rate remained relatively unchanged.
Yep.
And this move preceded us heading into the October lows.
Yeah.
And when we had peak bearishness, heading into October. And
Second,
now if you'll move on to
second
the
chart.
second, yeah, let's go to the second. So this is now, right? And we're seeing a similar sort of thing happen where we have high yield spreads jumping and the AAA triple B spread staying relatively unchanged. And what this sort of tells you is that participants are starting to risk off from their high yielding, high risk bond investments.
Yep.
Which tells you that there is an actual money where the mouth is fear of the economy going into a sort of down cycle, right?
Yeah.
So that's kind of why that happens. And I've always called it like the bottom up, right? These sort of effects in the bond market usually go from the bottom up, right?
Yeah.
In terms of quality, like credit quality. So it's kind of what we're seeing. I expect AAA, triple B to follow more so than I expect high yield AAA to drop,
Yeah.
back to relative performance. That's usually kind of the way it works. It depends on how long this lasts and what kind of things come out. But it does signal that participants are expecting bearish data, coming up over the next, I don't know, 2-3 months maybe. I don't know if it's bearish news, bearish data, whatever it is. They're just expecting something like that. So something to
I think broadly
of.
there's a pretty high expectation that we're going to see, at least a significant drop in growth into the second half of the year. If not a recession into the last quarter, early next year, right?
Yeah, I think the market is starting to realize that.
And I think the
yields are gonna
bond
end up.
market's kind of leading that assumption.
Yeah, exactly. They
Yeah.
definitely are. If you want to move on to our next chart.
Yep.
Before you move on,
Yes.
since this chart keeps coming up, and the first four letters of the chart are BAML, and then there's a ridiculous amount of letters afterwards. I propose, and I'm trying to get this to stick, that this is the Bama Lama Ding Dong chart.
Okay.
How do we
Bama
feel
Lama
about
Ding
that?
Dong.
Bam Lahoa. High C.
What about Black Betty? Bama Lamb.
No, we can't recycle old
Yeah,
material.
that's an old material because of hand banana, because it was
Yeah, it's
I forgot
that's
about
a deep cut.
Yeah.
Okay.
Yeah, so the Bama Lama Ding Dong chart.
All
All right.
right.
We'll
Well,
call that.
here's your favorite chart, J Fresh.
I know.
Let's talk about steepening and bulls.
Yeah. So
No, he described it to me before you started the stream. So I was like, "What's going on with this thing? Well, there's so many colors and arrows." And he used the phrase "unsteepener," and I wanted to strangle him.
You could say bearish reversal instead of bearer unsteepener. Or wait, are you calling it a bull unsteepener? In which case, I fully support your decision to aggravate J Fresh.
Yeah, it was a bear unsteepener. That's what I called it.
Damn.
So I just pulled up some yield curves over the past few months. And I drew some arrows to show so the purple line, right, with the purple arrow, that was in September 2023. Okay.
Yep.
And then in October 2023, you see what happens. We got a crazy bear steepener, right, for a couple months.
Yep.
Okay. And that was interesting. And I remember we were talking about it like it was steepening with momentum.
Yeah, we should probably also talk about the fact that UST short volume reduced by like 80% from end of October through beginning of January.
Right. So yeah, so that was gonna bring me to the green arrow, right?
Yep.
We saw the bear unsteepener just so fucking hard, right? Like we went right back into the same regime, and then here is the most recent print, I believe, on this website was the blue line at the bottom, and yeah, like it's just the whole time you're seeing a shit ton of bullish action on the long end of the yield curve, right? I mean, honestly, almost the entire yield curve saw bullish action over that period from November to now, right?
Short squeeze.
Yeah.
Yeah, yeah, right. So yeah, it's pretty much like it's because we know that the short interest on bonds was just is it was absolutely insane. It was the largest in history heading into October, right? Like just so gigantic. And I'm sure it was getting levered into more and more, especially so a lot of that is the basis trade, right? And I kind of keep talking about it, but that basis trade is sort of how liquidity happens in the U.S. Treasury, quote unquote primary market and the futures market is through the basis trade.
Mm-hmm.
So and the thing about the basis trade is you just end up accumulating a whole lot of positions because it's leveraged. And so when there's unexpected moves, while you're in the basis trade and while you're doing it, your hedge, which is on convexity of the yield curve and the vol curve,
Yeah.
gets all kinds of screwy and out of whack, and you have to go and hedge it. And if you can't get the dollars fast enough to hedge it, that's when you can't keep up enough to not get margin called, and then your fund it makes sad faces and
Get
all
a
that stuff.
liquidity crunch.
Yeah, right. Well, I mean, it depends on how big you are, but yeah, if bigger and bigger participants start having a harder and harder time finding liquidity to hedge their basis trades,
I think the
like
draining
JP Morgan.
RRP already tells us a lot about that story.
Oh yeah,
The
yeah,
rate at which RRP is draining, right? Because once they move to draining reserves, all the liquidity that the market's been enjoying since November just disappears.
well, so
Especially
the
if
fact,
QT continues. Well, if
yeah.
QT continues.
So to touch on the fat tails and their relation to the basis trade too, I think that the reason we've been having fat tails on these weird durations, and I mean like really big ones, is that people are not engaging in the basis trade like they were at the beginning of the year, right? Where
Yeah.
you were having people just because the basis trade relies on you just buying fresh treasuries at par, right? You're setting your par value there, and then you're shorting the derivative, right, which is the futures market. And we are seeing a strong reticence to continue with this basis trade because I think participants are starting to get nervous about their ability to hedge, large swings in yields on whatever news, right?
Yeah.
Especially like we're seeing a beautiful exhibit of the sensitivity of the bond market to any sort of interest rate affecting news, right? Whether it's the Fed dot plot or a soft inflation print. The bond market just reacts like crazy. I mean, these moves are
I
just
mean,
insane.
volatility in the bond market is still sky high, right? So it's like, I mean, we may be like in a technical bull market on the SPX side, but the bond market's still very, very much in a bear market.
Oh fuck! It's in a crazy bear market too. Like
Yeah.
it's pretty historic what we're witnessing in the bond market. So I mean, and that's sort of how things like the basis trade gets overcrowded like it is that you want risk-free yield, and when the treasury market itself is not like really a risk-free trade of earnings or a low volatility low risk trade like it usually is, it means you have to seek out some sort of risk-free yield to pad any sort of purchases you do.
You mean like
And
short vol?
yeah, something like that.
Ah, interesting.
But you got
Um,
a couple. So Carl says yields back above 5% this year. I think so.
I
I think
agree.
absolutely.
I agree.
I think it all
Uh,
depends. It depends
I
on
mean, I
inflation
really hope
data.
so too, because I sold all my duration at the end of last year, and now I have no treasuries left. But
So I think it all
I made
depends
more
on
money than anybody who bought SPX at the bottom, so that's awesome.
that's good. But yeah, I think it depends on the inflation data. If we continue to get softer prints, then yields could stay pretty low. But if inflation picks back up, which it sounds like because the container prices jumped like 1,000% or whatever,
Yeah, the
we're probably gonna get that stick.
The Black Sea supply shock could be a bit of an issue.
yeah, that's not
I
going to
don't
show up in this one, is it?
No, I don't think it's going to materialize for a little while, but I do think that around the time it materializes, which should be like early spring, I think we'll also be seeing our healthcare stats shift over. And those are going to be reweighted against the new higher base. Um, and so I think we're gonna get all of that all at once, and that's gonna be a crazy couple months. Like May, June, July, I think is gonna be wild.
Yeah, I agree. So if you want, we can move on to the next chart.
Yeah.
So this is a series of three. You can just start the first one. It's in like 2000 or something.
Yep.
So this is just the yield curve sort of over time, right? And it's just a rough proxy, right? You have the 2, you have the 5, the 10, and essentially the 30, right? So what you'll notice in, there are these periods where spreads get blown out, right? And
Yep.
you could see, like, you very clearly see the envelopes on them.
Yeah,
And so I just want to
2008 through 2010, 11, and then like 2013, 14 starts to kind of get back in line in 15, and then 15,
yeah,
16, early 17, then everything tightens up after 2018. At which point
Volmageddon.
things go great all the way until we hit the COVID crash, and now we're here.
Yeah, so notice how the spreads, like, normally, so if like you go back to 2000 and look at that sort of spread blowout, what you'll
Yeah, from
notice
the
is that
dot-com bubble.
yeah, so what you'll notice is that spreads blew out, and then and the Fed put came in, right? And what we saw was, yeah, spreads blew out, Fed put came in, and then it just slowly sort of retightened, right? And recompressed and stayed sort of pretty much fully collapsed for the better part of a year, right? Before what you see is what you're seeing is like the yield curve start to invert, and then, people start getting bullish on bonds when that happens, right? Or
Yeah.
they start getting bearish on bonds, my bad. So and then you'll notice in like 2007 spreads, like financial conditions loosened for a bit, and then they kind of retightened, and then, all kinds of shit broke, and then Fed put came right back in with extreme gusto. And then on the next chart we see what the results in 2008, where, Fed cut interest rates to 0, and then, you just see the yield curve this time blew out, and it took a very long time for it to recompress. And every stage of recompression that happened led to some sort of bearish event in the market, like a pullback.
Yeah.
And like you'll notice I think Volmageddon was 2018, right? So you notice heading into 2018, we see a violent compression of the yield curve.
Yeah.
So that sort of it just sort of tells you the relationship between bonds and volatility.
Which is
That
something also we should note that is strengthened over time because of the number of derivatives on volatility that became tradable, right? So when we go back and we look at like 2000, 2008, the number of volatility products in the market was simply nowhere near what it is today, for instance. And part of what like promulgated Volmageddon was the fact that there were so many volatility products available with which to short, that it allowed the short position to become wildly overextended, beyond what would have been mechanically feasible prior to that. And now we have even more, right? We have even more
You
than
guys
we
don't
did in
think that the
2018.
2x long VIX futures ETF being on the reg show threshold list is bad, dude?
There's been some very strange reg show appearances by several volatility funds,
Yeah.
and more recently, like a lot of the high yield stuff has been dropping off.
Yeah.
And so
I noticed
I
that
expect now we'll see short vol start to like the short vol funds start to pop up on reg show, and then the long vol funds fall off.
yeah, the
so
list is actually pretty short right now, though. I mean, I think that just reinforces the idea that we just went through a massive squeeze of the last few months of, pretty much everything.
Yeah, well, like at the beginning of November, they're like, well, right around the time
Yeah.
UVXY came off, it was like all like high yield bond funds.
Yeah. Yeah.
And then those are starting to fall off now, and then I think now we'll start to see like short vol funds get over short.
Yeah. So I mean, yeah, and just to kind of bring it all full circle, why don't you pull up the next chart, which shows, that compression and the spread blowing out in 2020.
Yep.
So this kind of shows the tail end of that compression event, right? And you can see the spread was starting to blow out even before 2020.
Yeah.
And they had to cut rates, right? Because they were tightening the economy or tightening financial conditions, and the bond market at that very at the very end of the peak was just like, fuck you, we're going to blow up. And so they, cut rates again. Spread blew out a little bit, and then came 2020. And it's really hard to tell from this chart, but those spreads in 2020 are extremely blown out. The percent differences between them, like the actual differentials, is insane.
Yeah.
And what we're seeing now is, the spreads have, tightened and collapsed. The yield curve has been inverted now for God knows how long. And what we've seen is spreads blow out the other way in a way, right? And that's interesting, because when that happens, that's when you start getting the driving forces of the bear steepener.
Yeah.
That's why we saw it heading into, and you could see that sort of recompression as the long end popped
I'm gonna
up.
say right now it looks like we're moving towards another period of compression.
Oh yeah, we've blown out a bit. Like it's,
Yeah.
if you zoom in on the chart, you'll see that those spreads have actually kind of widened just the tiniest bit throughout that drop. But yeah, what we were seeing was the long end of the yield curve sort of, starting to catch up to the short end. And then the moment that happened, right, we got, softening Fed speak, and, the dot plot and all that shit, which, re-steepened the entire yield curve. It blew out spreads the other way again, right? And this is sort of just the bond market and the I don't know if it's the Treasury or the Fed, probably both, but they're all fighting for the bull steepener to happen before the bear steepener really rears its ugly head. So if we get more hot inflation prints, we're going to see the bond market really start to price up what it's willing to accept. And in that case, we will see short-term yields, spreads possibly blow out again to the upside, and then we'll see a compression back up around the 5% range. And I think that's kind of so far looked to be near a threshold limit for us. If we break through that 5% yield regime and we push to like 5.5 on the on the shorter end of the yield curve,
You're gonna love the next DD I write, by the way.
I bet I will. We'll see the if 5-year goes up to 5.525. We'll see some serious volatility in the market, because that's just it reflects a more uncertain economic outlook.
Yeah.
Whether for inflation or real GDP, it's not looking like the bond market is super bullish on itself or the economy right now. It's just really just a sad face.
Well, we could kind of talk about the interplay there that we're seeing already with Dixie and well, I think Dixie's an important one to note. Obviously, as we've started to see yields, and this is, a much more zoomed in version of the top end of the curve, right? Um, from that reversal point where we start to see local tightening, we're also seeing dollar increase, and remember that this has negative effects on like for forward earnings, especially for multinationals, that maybe not being paid internationally in dollars and converting back to dollars. It tends to see a widening of credit spreads, which we are seeing, and it also tends to see an increase in interest and volatility. And something else to mention here is if banks believe for a second that we are going to see the top end of the yield curve move back up, they are going to lean as hard as they feasibly can into the carry trade. And this is something I talked about well in advance of it happening. And I'm really glad I got that information out there before it did, so people can see just how important the effect of the USD JPY carry trade is on current US financial conditions. But a second our financial conditions started to tighten, we see them leaning back into the spread. We see yen falling dramatically. I think we've seen yen drop, how much over recent weeks? USD JPY pair has fallen.
Let me see. It's fallen like almost 2% over the last couple weeks.
Three spiking at almost 4%. And the reason they're going to do this is because as they start to pick up risk in the bond market, they need to offset that risk by lending as much as feasibly fucking possible and increasing their net interest income. And this is how they do it, right? This is how every bank in the U.S. is dodging the Fed, preventing the actual tightening of financial conditions, and staying afloat. The reason I think that we don't see significant Fed rate cuts this year, and I think we see the Fed move towards that hard landing target that I discussed a couple of weeks ago on Twitter, is that the banks will fail. I think banks will substantially fail, both if the Fed cuts and cuts off their access to this significantly lower rate funding, or if yields get above 6%. So I think there's a really, really delicate balance, and I think JPAM may be less inept than we assume, and I think he's trying to find somewhere where we have stability between, like a 4.5 to 6% rate, realized rate on U.S. Treasuries. I think if we go over 6, I think banks fail. I think if we go under 4, banks fail. Substantially under 4, banks will fail. So bull steepener, banks fail. Bear steepener, banks fail. And so I think we see a period this year where we see the Fed behave in a very wishy-washy manner, moving back and forth from hawkish to dovish, as they've done moderately in 2022. I think we'll see even greater extremes of that same behavior, and we'll see financial conditions loosen and tighten cyclically, until these banks can start to get themselves out from underwater. Debt economy and value exist in spite of failures in most cases. Just food for thought. Yeah, I know it's not going anywhere. Anyway, so I wanted to add that little bit of insight to the how the carry trade's affecting these things, and we can kind of see some cool correlations there also with the yield on vol increasing, and yet treasuries are still kind of fighting back. This may ease a little bit for a period, right? Like we may see treasuries fall back a little and vol fall back a little, but the next time it tightens, it's going to tighten even more, and we are going to see that pinch point occur. It's inevitable. And when it does, we're probably looking at a protracted recession.
Yeah, it'll happen one of two ways, right? You described both of them pretty spot on. And we could even see, a direct correlation between the carry trade and the forward returns of volatility, right?
Yeah.
It's very interesting, and to try to explain why that's happening, you essentially you have to think of it as, when demand for treasuries spiked super hard, which they did, whether that was from short covering or whatever, take your pick. But when that demand spiked really hard, we see the value of the carry trade, reverse pretty strongly as well.
Yeah. Well, that's because the spread is narrowing. And remember that when we're talking about this, we're not talking about the central bank rate. We're talking about the effective rate realized in the bond market. This is where it matters. If JPOW, it doesn't matter what JPOW says, right? If real rates are on bonds are sitting, between 4 to 4.2%, that's a significant amount of pressure on the carry trade. Versus rates sitting at 5 to 5.2%.
Yeah, and this is the sort of or the first downstream effects of this are on like overnight liquidity and those sorts of things.
Yeah.
So it's going to be interesting, what's going to end up happening over the next few months, right, as the next bit of data comes out. I think that if inflation prints stronger, which it seems like it will, we're gonna see some interesting stuff. One thing I wanted to bring up, Girk, is God, what was it called? Like a Arctic ass blaster or something is coming in.
Wait, what?
So there's Arctic ass blaster.
Continue. I want to see where this is going.
And it's going to bring in like 30 degree below average temperatures to a good portion of the United States. So
we're getting like a big Arctic front. That'll be interesting. Exactly. What about Europe?
Yeah, Europe I think matters more.
I think Europe might be getting one too, but this is going to cover like the lower 48, like pretty much entirely. So we're going to probably see nat gas futures go up.
JFresh, protect yourself.
I know.
Your power grid's going to go bye-bye again.
Oh my god!
I don't want to dig you out when you become a human popsicle.
I'm connected to a water treatment plant, so actually my power didn't go out at all.
Stop doxing yourself.
There's a lot of water treatment plants.
No, there aren't. There's no fucking water.
Yeah, but I lived in the north, the Midwest and the north for like 5-6 years, and I still made the rookie mistake when the freeze came in Texas and forgot to leave my water dripping and spent like a whole day trying to de-ice the water line in my garage that had frozen solid.
Ouch.
That was fun. Yeah.
Have you tried wrapping it in asbestos?
No. There's such high demand for asbestos in Texas that you can't even find it.
It's for the furry suits.
So yeah, I think nat gas prices are going to go up a little bit. Just my thoughts on the next.
Maybe. Yeah.
Maybe.
I don't know if it's really going to matter.
I think so nat gas is kind of like the sleeping giant there, right? If we see speculation on nat gas rise, right? If people are like, "Oh fuck, nat gas is going to go up because it's
going to go up
all-time lows," it's going to go up far in excess of the actual demand, right? Not to mention just the sheer size of the short position on nat gas as well. So yeah, Henry Hub futures could just go absolutely apeshit if there's any concern that either EU reserves are going to trim back or be insufficient for the winter, especially with nat gas shipping being at least moderately delayed by the shit that's going on in the Red Sea. Yeah, that's a powder keg. And especially for inflation.
Yeah,
right?
But is that going to have more of an effect on rising inflation or just lower output? I think it's still hard.
So output should stay the same, but it's reserves that'll drop.
I'm saying just in general for the economy, like from a GDP perspective.
I mean, it would be a huge effect on inflation, yeah. Because right now it's been dead for a year, right? It's had no realized effect on inflation at all.
But I could see.
But it's a huge part of the energy component.
Well, I mean, I could see that for gas because gas is built so heavily into, everything. But I don't know. Nat gas is more targeted. It's not. I guess that's
Well,
not fair because a lot of
easy as natural
turbines
gas. I mean,
run on that gas. So
there's a good amount of stuff that runs on nat gas, and I mean, a lot of homes are still like a lot like furnaces, those kinds of things all run on nat gas. I mean,
There's
unless you're like you have
nat
a
gas
dump fuck.
power plants all over the place.
Yeah.
I
So
retract my statement
They
because that
converted
is
all the fucking. That's why Germany was going back to coal, because they converted all their power plants to natural gas.
yeah, from Russia. So it's an interesting thing. I just wanted to point that out that that's probably going to happen. I don't know if necessarily like this thing is going to go on for a while, but it could. This cold front could last for like a few weeks to a couple months. So one, brace yourself for a cold winter if you live in Montana. I think like they said wind chill down to -70. But also nat gas is probably going to rise. I don't think I'm going to play it unless I see a very strong sort of bit of momentum into end of day, like on oil or something. I might end up like
This
doing
is
like an
why I
overnight.
started buying nat gas utilities. Was because they
Yeah,
would
that's a
stay
good way to play
stable
it.
regardless of the nat gas price, but they would improve greatly with nat gas going up.
Yeah, that's a great way to play it. Just some sort of simple low risk position in a nat gas utility. You could play the prices themselves, like with oil or something, but I'm only really going to do that if I see, volatility on nat gas futures spike strongly. And then even so, it's probably going to be, overnight straddles of some sort, not really necessarily calls, right?
So we would need to calculate the rate of change in nat gas prices over the current weight in CPI to determine the impact on CPI.
Yeah,
So,
pretty
like,
much.
if nat gas has a weight of 5% in the energy basket and its price increased by 10%, we would see a 0.5% move up in CPI. I think we could probably do it if we cared enough.
Probably.
yeah. I mean, you could definitely do that kind of math, but I think in general, the energy basket is really difficult because it's embedded in the price of everything, and it's really hard to tease that out. And I'm sure they try to do that,
They
but
fail horribly at it.
yeah,
But yeah, it
it's
is. You're
I
right.
can see it's easily it's such an impossible task to get right
Spikes
that
in energy costs have a lot of knock-on effects over time. So you get like a big spike in gas, right? And then it dies off. But then, 3 months later, you can see like, consumer prices move up. You can see 2 months later, you'll see production prices move up, right? Like as that spike filters out through the economy, it actually takes a long time for those spikes in energy prices to diffuse to the point where they don't matter anymore. And if we were to simultaneously get a spike in gas prices as well as nat gas prices, fuck. Well, oil and nat gas, right? Then you can just see it. Then we're back to like early 2022 with the Ukraine Russia like supply freak out. Um and we just saw inflation rocketing up, right? Because nat gas and oil were moving. And in a lot of places, you have nat gas being used not only for heating but for electricity as well. So the cost of it bleeds out into production. It bleeds out into things like fertilizer, if you guys remember that. Um, so yeah, nat gas can have some pretty wide reaching effects similar to oil, and especially with the current supply route contested and an increase in demand, that could create a ton of realized volatility in several asset classes.
Yeah, it's going to be interesting to watch it play out, but I mean, it all depends on the weather and how long this thing lasts, how hard speculation comes into nat gas. Like, there's a lot of variables.
Well, what'll
So
happen is speculation will pick up initially a little bit, right? And then if dwindling supply and insufficient supply or dwindling reserves confirm that speculation, then it'll just go absolutely fucking bonkers.
Yeah, that's gonna be it's just
And then if
it made
China's
me think.
reopening at the same time, Poopy Pants has got this right. If
Dude,
China's
China's been
reopening at the
reopening for a
same
year now.
time, we get a commodity super cycle and $150 a barrel oil, right?
What's
Dude,
going
China's
on with China? How are
They're
they?
really,
I mean,
really
they're
trying to buy themselves out of their. I mean, they're basically. Well, the interesting thing about China is they're basically at the end of they're nearing the end of their financial crisis, right? They're cleaning up the issues. They've still got a few failures happening here and there, but for the most part they've contained a lot of the real estate failures on a broader level, and they've managed to keep their currency relatively stable via US Treasury purchases, right? But you know, they're trying to QE themselves back into, you know, some growth. So far the results have been lackluster. But if there's any indication that, you know, manufacturing output's picking up, productivity's picking up, consumer spending is picking up, which it actually is, and their rates are going to continue down, then it could all happen very fast, right? Like we could start to see money moving back to China really, really quickly, and a lot of that money is currently sheltered in U.S. Treasuries, U.S. equities, right? Um, and obviously everybody has their eye on China for that, but alongside that is going to be increased demand for natural resources, right? And specifically with the OPEC cuts, oil. And you know, right now, China's manufacturing capacity and output are really low. At least historically, I mean, I think HSI is back to like where it was in like the '90s. So like fucking 20 years of growth just gone, right? But you know, if that sparks back up, if there's a real indication that China's going to start growing and growing at a, you know, a pace above average, we're going to see a ton of commodities demand get factored in, right?
I mean, China's been reopening for like 2 years now, haven't they?
Well, I mean, the U.S.
yeah,
is doing
the,
like, you know, everyone wants to talk a lot of shit on Biden, and I agree for the most part. He's been a mostly useless president, and he largely got voted in because people just didn't want Trump in there again, right? But his foreign economic policy has been disastrous for China, right? He's kept them out of the gains from the AI bubble. You know, he's limited the amount of production, like the amount of goods that are being purchased by the U.S. from China. Mexico's imports into the U.S. have blown up. He's doing
I'm
everything
bullish on
he
it.
can to keep U.S. dollars out of Chinese manufacturing hands, right? And he's really been pretty successful at fucking their economy. And as long as he can keep their economy fucked until ours starts to recover, then the US can get out ahead in the long term, right? I don't think that's going to happen. I think China's rebound will probably happen before ours. And then once again give them the growth advantage that they had seen from, you know, the mid 2010 to 2024. But maybe they'll have less of a lead this time, you know, and that might help.
Yeah, I don't know. It's almost like the pattern of nationalization, right, is what kind of Biden is sort of setting the stage for by doing that.
Yeah, yeah, it's very like pre World War I, right? Where we see all these countries that had prior to that period been starting to work with each other pull back and develop more isolationist policies and reshore manufacturing and industry. You see Europe pulling a lot of, out of necessity, pulling a lot of industry and manufacturing out of Russia and China. You see the U.S. pulling it out of China and trying to redistribute that manufacturing capacity to places that still have cheap labor, like India, Mexico. And so I mean, broadly, it's a shift in regimes, right? And I mean, but everyone kind of wants to take advantage of China being down, and out of the game for a little while to pull back all the power that they've allowed China to accumulate over the last 10 to 15 years, right? Like
Yeah,
we all let China run a little too hot, too long, and obviously from a social aspect, their policies don't really align with most of the Western world. Now I think China will do great as long as they don't do anything stupid like try to take over Taiwan.
I mean, this has a lot of rippling long-term implications for our labor market that are kind of troubling, right? Because I mean, we've been exporting a lot of our inflation for a very, very long time to countries like China and India and obviously in Mexico. And obviously that's not going to stop completely, but it's definitely going to slow down.
Mm-hmm.
And also, we've been, in my opinion, we've been pretty aggressively anti-immigrant for quite a while now at the same time.
Yeah.
And so you have sort of this growing demand for workers that's happening quite rapidly that I think is sort of masked by, all of the COVID volatility. But it's pretty clear that there is a much stronger demand for workers than there were in the past domestically.
Mm-hmm.
And if that continues, then, thankfully workers are going to continue to be able to fight for higher wages.
I think I think socially we have another problem there too, like kind of in line with what you're saying is, besides losing the upper part of our working population pretty dramatically over the next like 20 years, we also have two generations of people that like none of us want to go work in a fucking munitions factory.
But
None of us are gonna go like who here wants to go make cars for $40 an hour? I don't. I'm not gonna fucking do that.
You know what though? You could make well over 100 grand welding. You don't even need a college education. You just need training, and you need to not be a bonehead. You need to be able to take some risk. It's a physical job, but they make so much money, and nobody wants to do it.
Yeah, that's the problem. Is no one wants to do those jobs that are showing up, right?
Yeah, there's actually like
if you ask any teenager today, like, are you going into like labor, or are you going into academics? Do you want to go into computer science, or do you want to be a TikTok influencer? And I guarantee you, the majority of them would rather be like an influencer, or
fair. But also, like when we were kids, we all wanted to be superheroes, right? So I don't think that that's a super fair comparison.
I mean, I think times will get tough enough that people will just adapt, but
we all have ridiculous dreams of what we want to be, and then reality sets in for all of us in unique ways. So I tend to discount that line of thinking to just kind of punch down at the younger generation as being somehow lesser than the previous generation. I don't think that.
I don't think they're lesser.
True.
I think their interests are just
I will say
aligned.
there is, and I think for a very long time. Ironically enough, the older generation that's now poo-pooing them have sort of been communicating to them that this is the path, this is the optimal path, and now everyone's taking that optimal path of going to college and getting a 4-year degree in literally anything.
That started with our generation, though. Like, none of us want to go do that shit. You want to go be an HVAC tech? Do you want to be a
But
plumber? Like,
I'm saying our parents essentially were the ones who communicated to us that this is the ideal path. You should do this if you want to be successful.
that's because
And
they
then,
worked in munition factories and made cars, and they were like, you don't want to do this shit. It's terrible.
yeah, no, I don't disagree, but and it will certainly cycle, but I think the government also played a big role in supporting that by essentially subsidizing that path very heavily. And, thankfully they are starting to subsidize the other path again, but it's still very weighted towards the path where everybody gets special studies. I think it's absurd to me that a college has a degree called general studies. Let's just put that out there. I mean, there's nothing more that says more about the imbalance here than that the college has a degree that's essentially high school again, more high school.
College
That
degree.
like
It used to be
high
business.
school is general studies. That's what high school is, right?
Mhm.
It used to be business class or a business degree that was a general studies degree, but now they just have general studies.
But
Or
now even business degree, we don't need this many business people, right? There's enough people that know how a business runs.
okay,
Jay
We
Price,
don't need more of them.
you've seen the charts of how many managers there are. Okay, there was a high demand for people with business degrees. Right?
Well, I mean that's a whole other social dynamic that we could probably get into. There's a
what about the
supply.
economists? Where are the economists going to work?
Oh God.
Wendy's.
Uh, I mean, but there's a whole the labor force is not as much of a supply and demand as you would imagine. They're much closer to fiefdoms of power and control. A lot of teams and hiring managers, they build their team as a sign of power more than as a booster of productivity, because we're making up most of the shit we do anyway, right? So productivity is mostly made up for like half of the population.
I think that most
Uh,
jobs are created on the back of somebody being inconvenienced at least one time.
yeah, but most of those conveniences are fabricated as well. They don't have to exist.
Like if I was running a business and something happened and I didn't like having to deal with it, I would immediately start looking for someone to hire to deal with that issue in the future, regardless of how trivial it is.
Yeah, no, I don't disagree. But anyway, I mean, we're getting a little down the beaten path here. But going back to my original point, if wage pressure remains high, simply because of shifting global and domestic demographics, then eventually assets have to come down, right? I mean, and hopefully wealth inequality will reverse in some small part, in some small way. Now, the question is are the people in power going to do everything they can to prevent that, which they're currently trying.
It's not working
But
very
it'll
well.
it'll be interesting to see. I mean, wages are now solidly above inflation, which is great.
Roughly,
The workers
I thought they were roughly neck and neck.
we were disagreeing on it. I think it's an issue of where we're getting data. I'm talking about the Atlanta Fed wage tracker. That's above
Which is weighted
CPI.
against CPI, which is currently imbalanced, right?
Yeah, I mean, obviously, you could argue the validity of any of the data. Regardless, I think both of us came to the similar conclusion that the worker hasn't caught up yet to the price increases, which
Well, we need a
it's
long-run
consistent with
period
the
of.
fact that everybody's pissed off and doesn't feel like they've caught up with inflation. I think it's insane to me that all the Fed members and economists and people are just bewildered. They're like, everybody must be wrong. The way they feel must be incorrect. Nobody can balance a checkbook and uh, quantitatively without bias assess their own bank accounts and their expenses.
We need a period.
Everybody
We
else
need a
must
period
be
of wage
wrong.
growth like substantially above inflation for like
Yeah.
3 to
Because
5 years.
we were below
Yeah,
for quite a while. So we need at least another year where we are now, if not more, just to break even. And I think workers are going to fight really hard for that. And so then the question becomes, uh, where do the profit margins come from to support what's going on right now in the equities market, right? I mean, we're still dealing with. I think most people are still sort of pushing for like 4 to 5%, 4 to 6. We'll say 4 to 6% revenue increases in line with GDP,
yeah.
but still 12% earnings increases. And so the question becomes, where does that 12% come from? Where's the savings coming from? Where are the efficiencies rising?
That's kind of why I think the soft landing is going to be significantly worse than the hard landing path. Is that corporations are going to fight back against that equitable wage increase, right? If we get the soft landing and the Fed starts cutting too soon, they're gonna push back as hard as they can against that wage growth. Then the population's still going to be a couple years behind, and then without that continuous wage growth, they're just going to start to fall further behind, and we're going to see consumer demand drop like a rock.
Yeah, no, I mean I don't disagree with that, but I think I think regardless, I mean if yeah, to me, if we actually somehow see these 12% increases in earnings growth this year, that to me is very bad, because that most likely means that the worker's getting screwed, right?
Yeah,
Which is going to weigh on the economy for quite a long time. Yeah, and it's kind of a tale as old as time. I just don't see how they're going to do it, because the worker is in such a good. There's so much demand, right? That I mean, I've been talking with folks, business owners around my town, and they're still having trouble just finding people willing to do the work that will enable them to be profitable. Right? I mean, it is a huge struggle, and obviously the very biggest companies have a lot of power to push back against that, but most of the companies don't, because there's always another one, right? And there's
yep.
always somebody else trying to survive that's willing to shave a little bit more off their margins to keep their livelihood going.
Well, that cycle of decline in dropping margins and increasing wages is super good for the economy in the long run.
Oh yeah.
It's just a question of if we can keep it going, right? If corporations get access to free debt too quickly, they're not going to want to pay the workers. They'll all unanimously push back, or on a larger scale they'll push back, right? And they'll use their the weight of the labor they already have available to them in order to survive any period of tighter labor conditions, or looser labor conditions, I guess I should say.
Well, they're going to push back by raising prices, right?
Yeah.
Because I don't think they're going to be very successful in pushing down wages. So they're going to have to raise prices.
But this is
right?
America.
And,
Margin contraction is a sin.
I know, no, it is, and that's why the Federal Reserve has put a lot of work in ensuring that doesn't happen.
What's the mortgage cost nowadays, anyways? $20?
Yeah, it's like a 4-bedroom.
Yeah, I mean, come on. What's a house worth? Like $100,000? Yeah.
What could one banana cost, Michael? $10?
That's what I feel.
Anyway, yeah. So yeah, I don't feel super great about equity. I really don't feel super great about the Russell 2000, where half of the companies aren't even profitable. I don't understand the spike in that at all, other than just
I mean,
rate
you
speculation.
gotta vent the money somewhere, right? Eventually, your diminishing returns on the other indexes prevent you from driving that up with leverage, so you drive up whatever's left.
Yeah, no, yeah,
Rising tide and all
yeah.
that.
Other than speculation, I don't understand why people think that this
I
is.
think I think there's good value in R2K, but I don't think the good value is R2K. Like
Yeah,
I think
I mean,
within
as an
R2K
index,
you have a lot of cash rich companies that are well suited to withstand any economic turmoil that may lie ahead. And I think far more cash rich than debt rich companies in the R2K than you find in the S&P. And so I can see a chunk of investors that are chasing that, but that's not bullish, right? If people think like small cap, high cash flow companies are the way to go with their investments, that shows a significant lack of faith in mega cap tech and like mega cap like healthcare services and health technology, right? Where all
yeah,
that debt burden really lies. And don't forget, and Gaff mentioned this earlier in the week, and we should probably talk about it a little bit more, but all these big mega cap corporations, they issued so much short-term debt to survive COVID. And all of that debt's starting to come due this year, and it's going to have to be refinanced. And so a lot of the vocal pushback against the Fed maintaining the higher rate for longer is due to the short-term maturation of that debt. And that if that debt's getting financed, it's, 800% higher than when it was issued. That's going to be a big fucking problem for a lot of these major corporations. um and I don't know how many are going to get out of the next 5 years solvent because of it. Like all
Well,
these
I mean,
corporations that have sparked up and done so well recently, like Salesforce and CloudStrike, and they're all sitting on these huge fucking piles of debt. That might be the one thing that Meta has going for them is they really don't have that much debt, at least not in relation to their cash flows. But all the rest of mega cap tech does, right? Nvidia's got shitloads of debt, Microsoft, all of them. Um, Apple, they're just sitting on tons and tons of debt, and they issued so much in 2020 and 2021 in order to offset the imbalance in their earnings, right? That now, now that that cash is going to be refinanced, they're going to be paying a ton more of their free cash flow out to service that debt.
I think
yeah,
it comes I think it comes down to a decision that needs to be made, right? It's not like these companies have to necessarily, re-up on this credit, but there's definitely going to be a point in time where they all have to sit down and make a decision about whether or not they want to continue with this sort of a financing scheme.
I
And
think a lot of it they are going to have to re-up because they took all that money and did stock buybacks.
Yeah,
or what they're going to do is they're just going to they're going to do layoffs, right? I mean, they're going to cut costs. That's another thing you could
What
do.
costs are they going to cut?
labor.
Headcount.
Yeah.
Yeah,
They can't.
There are
yeah, they
definitely
can,
some companies that have to re-up. Tesla?
dude.
Wait,
They
hold
cannot
on,
cut.
hold
They
on.
cannot cut their labor and
Gaff.
maintain their revenues. So look at you mentioned Salesforce. Look at Salesforce. What did they do? They cut labor, right, to maintain their margins, and then they had to turn around and hire them back for even more because they couldn't actually meet all the contracts that they sold because they didn't have enough workers to do it. So I don't think that there's really all that much more labor that can be cut and still maintain the revenues that they're trying to maintain.
It
So
starts from
what?
the bottom, Fresh. Like they were cutting headcounts before we were actually like before we even saw any real maturities. So we were talking about big companies facing maturities, but they're not the only ones who took out leverage during the easy finance period. I mean, you're talking thousands and thousands of small companies that have also done the same thing. And when they start cutting back their costs by, potentially reducing headcount or some other way by perhaps buying the cheaper service or going with a different service, or just removing it altogether, then you start seeing those knock-on effects to larger companies where they're going to have lower demand for their services, and that's where you start seeing the cost cutting happen. And it's all going to happen right around the same time. There may be a little bit of a lag effect with the larger companies, so they may lever up, still forecasting strong growth, and then end up having to cut costs anyways, and also having this large overhead debt burden.
So I think if these companies in general are going to run into an issue where revenues are in danger, uh, they're just gonna they're not gonna be able to cut enough costs to offset it. I think they're already running so lean to try to hide everything that if revenue slips, that's super bad.
Well, of course, yeah, that's it's obvious. Yeah, I mean, like
I also just don't think revenue is going to slip. The
Here's
government's
something.
still
Here's something else I
printing
want to
so much
discuss.
money.
Is let's forget about the. And I know I've talked about this way too much for anyone's comfort, but let's forget about the publicly traded stocks and the mega cap tech and all of that, right? And let's just look at like the largest employer in the U.S., which is small businesses, right? I think they employ just short of 50% of the population, right? Or just over, I'm sorry, just over 50% of the population. Those businesses really did have to take loans during COVID to survive broadly, right? And those uh, credit facilities are variable rate, generally speaking, right? And they're deeply underwater on those facilities already. Small businesses have not forecasted a lot of growth for this year. They almost unanimously forecast that they're going to have to cut employees, right? And that's really where you see, I think, where we see unemployment spike. Not Google laying off 30,000 people because their new AI is better, right? But be like mom and
That
pop
was actually
places
that
laying
headline
off.
wasn't even true.
I know, but like mom and pop places laying off half their workforce because they can no longer keep up with their interest payments, right? Then, they lose half their workforce, they lose that profitability over the next year, and then the year after they start to buckle under the pressure of that debt and fail. Um and
yeah,
that
when you're
is
talking about
that is a
laying off
huge
20
that is a
people, you know.
huge amount of the PPP loans going out and being largely forgiven. That helps bolster that. It helped bolster that, but they all took on far more money in excess of those PPP loans, right? There are very few businesses that just took the PPP loans and were able to survive. They all had to lean on those credit facilities, and we saw that in the spike in bank lending to small businesses throughout 2019 through 2021, right? Um, and so I think that's something we don't talk about a lot, but really does affect the economic situation in this country. Like we always, as traders and analysts, we always focus on everything that's publicly traded, but there's a lot
Yeah,
under the surface of that, and the impacts of that are enormous, especially banks, right?
But yeah, I
That's
mean
what all these regional banks, all these major banks lending to
I
these
mean
small businesses, and now you have defaults. You have defaults
even
popping up everywhere.
even the treasury rates and yields and things like that are affected by these small businesses. I mean, think about it. If thousands of small businesses are facing, reduced demand but still have the same overhead costs, then they're going to have to lean into debt a bit to have the liquidity to cover those. And so you will actually see things like the 1 year, the overnight, things like that start to move in response to the demand for this debt, right? And that's it's like, you kind of see it in like post GFC, right?
Yeah.
And heading into like the major rate cuts, you see like the access to credit lock up, and at the same time, demand for it spikes because you're starting to see businesses, especially in the financial sector, really need that debt and not really have much access to it, and so you'll see these sorts of the illiquidity in the treasury market combined with high demand for credit at the same time, really tank yields before the Fed even responds. Like
so
it's
yeah,
all
you just kind of sparked an interesting idea in my head because as you both were talking about all of these things, I'm thinking, okay, well, where's the unemployment rise? Where's the unemployment rise? I mean, 3.4 to 3.7 isn't really indicative of much of anything, right? To me, I consider that statistically flat. Um, Other people might disagree, and maybe they're right. I don't know how much confidence I have in saying it's flat, but let's just say it's roughly flat. Why aren't we seeing this start to uptick? But then I was thinking, well, the thing that might be different this time than most every other time is sort of like coherence versus diffusion. And I know that that sounds nerdy, but so let me. In general, most businesses are operating roughly independently of each other. There's obviously some cyclical behavior that occurs and seasonal behavior, but businesses are basically, you can assume that they randomly will start, equally likely any day of the year, right? But and so they'll take on debt and notes and things like that at randomly at any point in time. And so then if things start to change in the economy, those changes propagate randomly, throughout the year. And so you start to see it as a smooth transition. But with COVID, everybody took loans on pretty much the exact same week, right? Uh, and so you would expect it, because it's also correlated and coherent, right? You would expect it all to blow up at the same time, and you wouldn't necessarily see this slow build. So yeah, I could buy it. If we see unemployment happen, it's going to be within the course of a few weeks. It'll go from great to terrible.
Yeah,
I
I
mean,
agree.
it depends on,
Spikes,
like, a few
well,
things, right?
historically, spikes in unemployment happen really fucking fast anyway. And Daniel Mack just mentioned why there is a lot of kind of like gerrymandering in the unemployment reports since they're surveys, and they discount a lot of things like if you're receiving unemployment and like how long since you lost your job and are you looking for a job? Do you have part-time employment? I think one of the big signs last year, and I pointed this out in a chart at one point, was that seasonal labor demand, which usually picks up very, very strongly into the holiday season, right? As retailers and logistics services all hire holiday help. Was actually
Right.
lower year over year on the entirety of the prior year. So not just lower than the holiday season, lower than the long run average for the actually prior 2 years.
Check
Um,
out the chart I just posted. That should, I think that's what you're talking about.
yeah, this is fine. Yeah, this one works. And so we're seeing a decline in seasonal labor help, roughly equivalent to you know COVID. If you look at the long run average from like 2014 on, right, and we're starting to fall into the territory, you know, of like the GFC, and that's 12 16 years of growth down the toilet, right? But yeah, we're losing temporary labor demand, and that's generally temporary labor is brought in to bolster growth, right? Like growth is ongoing, labor is insufficient to maintain the current rate of growth, and so you bring on temporary labor, and so you can bring on more permanent labor, right? And that allows you to get over the speed bumps of scaling up. And this tells you broadly that businesses in the U.S. are scaling down. They're not. There's very little demand for that seasonal or temporary labor.
Yeah, don't quote me on this, but I think inflation adjusted the seasonal sales, like holiday sales were down.
Yeah. A lot of people are so. I know Mastercard released a preliminary. We'll start to see more reports on retail sales for quarter 4 coming in through like the next month and a half before we get to those Q4 earnings. But yeah, I think broadly sales are down. There was a lot of buy now pay later, which is
Mhm.
obviously not a fucking good sign. But yeah. And something else. Gaff says there's 64 high yield issuances in consumer discretionary alone, which aggregate to nearly 25 billion, and will need to have some sort of reissuance in the next 18 months. And Cobra mentions SBA loans are terrible for small businesses. I've got clients paying 10K a month in interest, and interest got paid off before it ever starts touching the principal. Also,
have another
yeah,
chart
that's
too.
another thing Twat Waffle is mentioning. A lot of the SBA loans and small business loans come with personal guarantees, right? So you default on your small business and you lose your other assets as well. So you can lose your cars, your house, because a lot of the times you have to come in and guarantee those loans yourself. And so
Yeah.
you're liable for them, and so you're not really very insulated from a default there, as an average person. And what is it like? 12-16% of Americans own small businesses, something like that.
Sounds like a statistic that's believable. I don't know. I
Yeah,
never
just
looked that up.
I can't remember what the number is. I'm sure there's like a survey or something.
I posted another
Yeah,
chart that shows that
it, it
our long-term growth trend is we're missing it from
yeah, for
20.
temporary help, sure. Yeah.
No, this is all total non-farm minus temporary help.
Oh, oh,
Yeah, that's kind of a nice little chart, but it shows and the trend is starting to flatten out and shows that we didn't actually nail pre-COVID growth trend from 2011
It's
through
like it's like
2020.
it's like 10% of the population. 33.2 million Americans own small businesses. Small businesses account for 99.9% of all American businesses. And there are 33.185 million small businesses in the US that employ 61 million Americans, which is 56.4% of private sector employees.
yeah. Okay, so um, the government is spending a lot of money, and that's propping things up. It might not be enough anyway, so we will see, and it'll all happen all at once. Everything will look great, and then it'll look terrible. I'm kind of putting all these ideas together into one coherent thought. And then what we're left with is a shitload of debt and a terrible economy. Where do we go from there? Do we just try to spend our way out of it again? I mean, I don't. Yeah, all right, that's fun.
Yeah, well, I don't think there's a spending our way out of it again without seeing credit ratings get downgraded in the US, right? And if our ratings
Yeah,
get downgraded, yields are going to go through the fucking roof.
yeah. Hmm.
It's going to
Oh,
be
that's
interesting.
interesting.
It's always so bearish and depressing when I talk to you guys. I get so riled up because government
What?
spending is growing at 7% a year, and everything's great. They're juicing the economy, and it's not going to matter.
It's really not like we've tried this before. Yeah. And 2019 was really kind of that whole thing coming to a head, and you know, conveniently, I mean, conveniently, a global tragedy struck and gave the global financial system the go-ahead to not only juice things, but juice them harder than ever seen before. It was like the entire globe declared war on a virus and gave companies carte blanche to sort of just take out unmitigated amounts of debt at complete zero consequence to taking out said debt. And the implications of this could be quite far reaching, right? And could last a long time to really fully unwind. But the thing is what we were experiencing. One, the inflation shock from the initial impulse was crazy. But longer term, right, what we've seen so far is, the reaction function of central banks that is starting to have, sort of its own impact. It's another sort of impulse, and it's all still playing out. But I think that we have witnessed a swift regime change, and I think that aside from central banks, I think the financial system is starting to realize, especially with inflation doing what it did and continuing to stay well above trend, we're seeing these financial institutions start to wise up to this idea that we can continuously juice the shit out of the economy every time something bad happens, right? The Fed put theory is slowly playing out, and not in the best way, because we've seen long term, especially over the past 15 to 20 years, how it's only exacerbated income inequality, and increased our economic sensitivity to down cycles, right? It's very, very interesting, and I'm interested to see how the next 5 years plays out, because of all this crazy reactions we're getting from central banks to inflation, and these fiscal impulses increasing in magnitude. It's just it's so fascinating and terrifying. I don't know. Long term, it seems like we're just going to get to a point where, you know, nations like the U.S., who have crazy high debt to GDP ratios, are going to have more and more frequent discussions about how to balance their book, and the debt issuances are only going to grow, and the confidence of financial institutions in the par value that they're receiving, being competitive enough for the future, decreasing as well, which is going to lead to a high interest rate regime. Not only high interest rate, but also higher than expected inflation, and a tighter than expected monetary policy for quite some time.
Yeah, I mean that's the thing that I think is scary and this is something that I'm trying to push back against, because I mean there's it seems like there's this pervasive theory since 2008, because we printed a bunch of money and there was no inflation, that we can always just print our way out. And I think for some reason everybody's just discounting the the effect of printing all that money uh, during COVID. I mean, it's very clearly that fiscal impulse was very strongly inflationary, and I think they were just different times, right? I mean, in 2008, credit ground to a halt. Uh, and so printing money was just there to prevent the continued destruction of broad money. Whereas here, it was printed, to prevent any destruction of broad money. And so broad money just started expanding as the printing continued, which led to this big inflationary impulse.
So
Um,
I just wanted to say too, you should your diffusion talk was really cool. You should check out those yield curve charts I posted, like the time ones, with all the different treasuries, because that sort of explains your diffusion theory that you're chewing on. So you should take a second look at those.
yeah, I will. Yeah, I agree.
So SPX. Let's get to the
Yeah,
last.
let's get to. We didn't even talk about options. It's
Yeah,
all on Twitter. I uploaded it earlier. It's all more of the same shit. Short
yeah.
ball,
I would
selling
say
short ball.
this week looks largely similar to the open at last week. Um, I don't see any significant changes. I mean, I guess we're seeing gamma neutral continue to move up, which is
Yeah, we're in a negative gamma environment now.
yeah, we
Well, I mean,
are.
you could argue for or against, but I think we are. If not, we're close. Um, so that's going to increase volatility, but I think this week is going to be last week on steroids. I mean, just violent intraday swings as short ball takes even more leverage, starts to fall in on itself. The negative gamma environment will exacerbate these effects as well. There's pretty much every morning there is uh, some data that could have an effect on bond yields, and then obviously there is some treasury issuance that afternoon that could also have some effect on bond yields. And I still think that the bonds are being heavily margined to sell puts to prop this up. So you're going to see basically two pumps a day every day. uh, and Where those end up,
Friday
I
gave us a
don't
little bit
know.
of that. Friday was kind of wild. We had the morning pump, and then we had the afternoon pump, and then the end of day pump. Right, so we got three in on Friday.
Yeah,
But yeah, I
yeah,
agree. More and more realized volatility, but don't discount the fact that we can absolutely bounce out of this range, and squeeze out some of the short interest to the upside. I don't think that particular mechanism has a ton of liquidity
yeah.
behind it. Like, I think we could squeeze out the short side, but we probably aren't going to break up anywhere near like the prior week's highs or anything like that. Um, Broadly across the market, we have ETF FTDs pulling back, coming in off of the OPEX. Those are going to be largely net long, right? So, um, we may see some additional volatility because of that. Like, I know SPY and QQQ have like a decent number of FTDs coming up this week. Um, so that'll have some effect, but probably in the earlier part of the week and not so much the latter half of the week. Um, God, I hate this range though. This range between like GN and DN, where everything's so up in the air, and we don't really have like that solid downside confirmation yet.
I
Because
think it's. I mean, sold vol is still fighting. With teeth bared,
yeah,
everything they've got. They're increasing leverage, doing whatever they can with what they've got, and to me, I think it's all up to margin and rates, right? So if rates spike, there's a good chance that we could squeeze down a little bit. If
yeah,
if rates drop, they're gonna pump. They're gonna want to pump back to all time highs because they're gonna want every single one of their puts out of the money again, and they're willing to do whatever it takes. And so if they're given that ammunition, they're gonna take it. And so yeah,
Speaking
it's
of that,
it's
we
gonna
should
be.
talk about the CFT positioning coming into this week. Equity fund speculators increased S&P CME net short positions by 29,188 contracts to 403,000 total. Fund managers raised S&P net long positions 77,000 contracts to
Jesus Christ.
950,000. CBOT Treasury Bond Futures net short position increased by 2,918 contracts, and Ultra Bond Treasury net short position increased by 11,000 contracts to 140,000 and 302,000 respectively. 10-year, 5-year, 2-year, all net short positions increased to 832,000, 1.2 million, and 1.24
2 year,
million respectively.
huh?
It's insane.
Yeah, it is.
It's actually crazy.
So this was the worst week since late October. Even with Friday being a green day. And we now have the 10-year, I think, substantially above 4%. Eh,
This
4.05,
this is
decently.
an easy question to knock out real quick. Can we touch delta neutral and go up from there? We tend to go through it. We don't tend to bounce on
Yeah, delta neutral's not a bouncy boy. Gamma neutral's very bouncy.
it.
Delta
Yeah.
neutral's everybody's fucked. Usually we test DN and then we fall below it by like 5%. Almost immediately. There's been, let's see, in the years that we've been watching, there's been how many bounces off of delta? It's so few. Um there was a
This one in
bounce off
March.
delta neutral in June, before we ran up through July. But that was really gamma,
That was
wasn't it?
also, I
That
think
was
that was
gamma.
more gamma, yeah.
Yeah.
So there was a bounce in March from below and it bounced
Yeah.
down. There was another bounce in October and it bounced down.
Yeah, but those are from below delta neutral,
Yeah,
right? Like
yeah,
actual
yeah,
bounces on delta neutral
yeah.
are
Bounces
are
up.
are
Yeah,
really really rare. Almost all tests of delta neutral lead to like a fairly significant sell off. Sometimes that reverses quickly, but you still fall below DN. Um, and I think positionally, like I know we saw like an uptick in gamma and delta on Friday, especially into the end of the day. But I think charm fell off again. Like we saw a midweek drop in charm, and then we saw like another billion on the weekly contract fall off yesterday. We haven't seen any substantial increase in charm for the Jan OPEX expiration. And normally around this time, we'd be expecting to see charm moving up a bit. As we
yeah.
now
Charm
that we're
is
only a couple weeks out well, yeah, I mean actually like 10 trading days out from the OPEX.
Charm is pretty low right now, and I mean, the reason for that is because most of the calls were kind of like sitting in between them all, and so they're all decaying in opposite ways and canceling each other out, and then the puts are all just mostly worthless anyway,
That
right?
reminds me of
So
something I mentioned to you the other night. Was it in our DMs? Something I said about the sold calls. I can't remember where I said it.
what'd you say? Do you
Oh,
remember what you said?
I don't know. It was
Ugh,
something that you brought up.
I don't know. We'll just move past it.
Oh, no, I remember where it was. It was in the quant chat. Yeah, oh, you were talking about oh, okay, never mind. Yeah. You were talking about like row or something like that. But I don't think it was
Yeah,
really
that
pertinent to
was
this.
me being pretty academic. I don't think that matters right now.
Yeah. But we're still negative on the adjusted delta. We're negative on gamma. Still not a lot of volatility short increasing on the OPEX contracts. Although we do see a slight uptick in calls, and then like it's a
Yeah, I mean,
really
what's interesting is I have I didn't publish these anywhere, but I just pulled like the days to expiry for SPX and the AM and the weekly contracts, and those are starting to substantially move over. Um, so the weekly contracts are kind of maximizing around the end of Feb, and which was odd. It's like the end of Feb and not OPEX. I'll have to go back and double check it. And then the AM contracts are March. There's now more contracts on March than there are on January. So I don't think there's any indication that anybody wants to end this sold ball train. They want their money and they're willing to do whatever they can to just scrape it. I
QQQ's in
still
a
think
pretty
it's
risky position.
I still think it's Brian Moynihan and that he's a lizard person.
I mean, I don't disagree with you.
Yeah, I'll die on that hill,
But
which is a ridiculous thing to die for.
yeah, QQQ's I think dealer charm. Dealer's going to start selling the flat tape on QQQ under 395. That's very bearish, especially with delta neutral at 392. Um, sometimes these are a better leading indicator of
They definitely tried to bounce it to keep it from selling the flat tape on
yeah.
Friday.
Yeah, they did. They pushed really hard against that. I saw that come in and it was like, holy fucking shit.
Well, especially
Um
over the weekend, because it have to sell NQ futures right
yeah.
overnight.
Oh, speaking of which, we should probably touch on Boeing. That's gonna have a pretty big impact on a lot of the breadth that's been supporting what little upside we've had this last week. Yeah, Boeing's in a bad place, and Dow's probably gonna get ruined in the overnight session. I don't think that's gonna be good for S&P. QQQ could kind of weather it, but
I will say, in general, I'm still not convinced that we've seen a whole ton of breadth. I mean, other than like IWM.
yeah, I agree. But
But
what
I
breadth
think that
there is has
IWM,
been very important.
I think that, yeah, but I think that IWM has been mostly, very short term derivatives based, right? I mean, all the calls on IWM were like record shattering. And I think that'll fall off and IWM will drop because the Russell's a sack of crap right now. The SPX, I mean, this has been ongoing. Like every time the SPX goes up, went up in 2023 and even now, you'll have a day where like RSP will do great. It'll go up like 1.5%, and the SPX will only go up like 0.5. And everyone will say, "Oh, this is great. Breadth is improving." And then the next day, RSP goes down 2%, and everybody just ignores it, and the breadth doesn't materially improve. And
Yeah,
that same story is still playing out here. I mean, it's very heavily weighted to the Mag 7, or if you want the Fantastic 15 or whatever.
I would say we
It's
saw
all
like
up
a
at the top.
big supportive spike in breadth here, obviously, but yeah, in the last few weeks, 3 weeks, just not much.
The Mag 7 is still at peak. It's up at like 27% uh,
S&P.
of the S&P, and before we started noticing all of this consolidation, it was like 15. So it went down from like 28 to 27. So there's your breadth.
Yeah.
It's like nothing. Anyway, what do you think? I got to run. My kids are dismantling my wife in pieces right now. But
All right.
uh,
Throw out your boy.
I'm just gonna straight. It's gonna be a flat line and just a wavy plus or minus one or plus or minus 0.5%, but no straight. Yeah, flat.
All right.
All right. Do you want my prediction yet, or you want to go first?
Well,
All
do we have
right,
another
I
fucking
gotta run.
holiday next week? All right, later, man.
My family's actually just physically melting. It's turning from solid to liquid. So
You go.
I'll see
You
you
go.
guys
I'll see
later.
you
Good
later,
luck.
man.
Good luck, guys.
Good luck.
All right, Dork.
Uh,
You're up.
All right. So from wherever the fuck it opens at, we're gonna go down to 46.50 by end of day Wednesday.
End of day Wednesday.
Yep.
All right.
I think it's the 10th. Like that.
46.50.
Yeah, 46.50 by the end of the day.
All right.
And then we're going to have a rise to 46.60 by Thursday. And then back up to 46.85 on Friday.
$46.85 Friday. All right, interesting.
Yeah,
Cool. I think
I
this week I gotta go kind of against the grain, which is neat. So I think we open low, on the back of the Dow. I think we'd get that 46.75, and then I think we move up, by end of day towards 47.20. Which day is CPI?
I don't remember.
Ah, fuck. Hold on.
I considered it irrelevant.
Oh, it's super important.
CPI is looks like, is it Wednesday? No, Wednesday's
Thursday.
Yeah,
Yeah.
Thursday.
So actually, you know what? I guess we open low. It changes my perspective a little bit. So I think we go trade lower into middle of the day Tuesday. Move up. Damn it. So open lower. 75.
Oh, I see where your head's at.
Yes.
Ooh. Papa Bear Gherk.
Yeah, I think like that. Nah, you know what? I'm not gonna give the end of the week that much love.
Make sure you color those things so I can post them on the
yeah.
quant dot plot.
There you go.
Perfect.
I think they use CPI to start de-risking Vega. And then I think after the end of this week, going into SLD, we probably get another pump. And then we see the bigger part of Vega de-risked into the OPEX expiration and following OPEX. So out past the 19th.
Makes sense.
And then post OPEX, like 2 weeks, I think maybe we start to see some bigger downside, and then like a move towards DN, which at that point should have moved from like where it is now, probably up towards like 40. It'll probably be at like 46.75 by then, for maybe 4,700. So I think that's good.
Nice.
All
Right
right.
on.
All right. Thank you so much for tuning in, Dork. I appreciate it. Fresh, I know you can't hear me, but you too, man. We'll see you guys tomorrow.
Thanks for having me on, bud. See ya.
See you, man. For the rest of you guys, 15th is Martin Luther King Day. You can't possibly be even on the end point. Well, I mean, I could go to like 4,700, I guess. There. The stream blows. Thanks, Gaff. Always appreciate having your support. If you guys have any questions, I should be around most of the day. Feel free to reach out if I wasn't able to get to your questions during the stream. And I'll have Pickles Picks out tonight for everybody. Thank you guys so much. Later.